so long expected, the number came in and it was not what the market was expecting. Certainly in terms of consensus, the second quarter GDP of South Africa contracting 51%. And when you look across all sectors, manufacturing, the big heartbeat of the South African economy, taking one of the big hits because of the lockdown that was caused by the COVID-19 pandemic. To help me explain the numbers is Etienne Leroux. He is Chief Economist at Rand Merchant Bank. And next to him, I mean physically even in where they are situated in Sandton, Annabel Bishop, Chief Economist at Investec. Lady and gentlemen, thank you for joining us. Etienne, you'll allow me to begin with the lady. I guess, Annabel, I just want your thoughts in terms of the key things here that tell the story of the damage that we saw with this number, especially those that surprised you.
Very sharp contraction, obviously down 17% a year. And of course, you know, the big hit to this 51% contraction was, of course, household consumption expenditure. You know, we saw a contribution there of 31%. So obviously the biggest contributor. And of course, you know, this year we are going to see that the private sector has lower incomes than last year. That's coming through in the figures. And of course, a big jump up in unemployment also expected as well. We saw from an investment perspective a drop of about 11 to 12%. You know, that's a contribution also to this 51% drop in GDP. And, you know, really, I don't think this was unexpected. You know, certainly we've been seeing for the last few months some very poor figures coming out from manufacturing, the industrial production sector, etc. But, you know, really, we've had one of the worst lockdowns in the world. And of course, now we're going to have one of the worst contractions in the world.
Yeah.
Okay, I think I'll ask you, Etienne, as well. We seem to be having slight problems in terms of what we're hearing each other. But Etienne, I'm hoping you can hear me. I want your opening thoughts as well, just along the same lines in terms of what you saw and the story that we're being told about the damage that came through in those numbers.
Sure, Godfrey. Just conceptually, we've been thinking about the COVID-19 shock as, in a way, two macroeconomic shocks hitting South Africa simultaneously. I think what is quite important here, we know that it is a global pandemic, and it actually was a big trigger for a deep global recession. Now, that's a big deal for a small yet trade-intensive economy like South Africa. So we would go as far as to say that the global recession on its own would be enough to see South Africa's GDP contract. Now, you add to that the consequences of a very severe lockdown domestically. You put the two shocks together and you can see the kind of numbers we saw today, an absolute devastating shock to the economy.
And I suppose what that means is that it's likely to change everybody's focus for the rest of the year for that GDP number. Annabel, can I start with you again? What are you expecting now? Do you revise your number? Do you go back to your model and see greater damage than you saw initially?
Well, no, you see, we expected about a 48% contraction in the second quarter, and we've really held that view since early June. So, you know, that lent us to believe we get a 10% contraction for the year. And I think we're still quite comfortable with a 10% contraction for this year. You know, the reality of the situation, South Africa can't see a very strong, robust recovery in the third quarter. We've got very substantial electricity supply constraints. And of course, you know, we've obviously seen the load shedding, but also, of course, well, all the structural problems we had before the COVID-19 quarter, the second quarter of this year, have come along with us into the third quarter. And those, of course, all continue to limit economic growth as well. But, you know, very importantly, a lot of economic indicators are lagging indicators. So, you know, we anticipate unemployment could rise to as much as 37% in the second quarter of this year. And of course, you know, some surveys have said 3 million people lost jobs. If that's the case, then unemployment's going to be closer to 42%. But if you take maybe 1.7, 1.8 million job losses, you know, 37% unemployment, that's going to feed through into a very weak third quarter as well. And sadly, you know, the weakness of the economy will also have some lagged effects as well. So we're not expecting to see a extremely strong recovery in the second half of this year. And indeed, we're not expecting to reach the levels of economic activity we had in the fourth quarter of last year before even 2025 in real terms. Such has been the extreme damage that has been done by this very hard lockdown.
Can talk about that. I wanted to know from you, Etienne, as well, whether you're changing your 2020 number. And I also wanted to break it down, Annabel, I'm warning you, the damage that came through because of the lockdown and the damage that came through from the factors that we knew were already inside the economy, including obviously power outages, etc., etc. Etienne?
Great. Thanks, Godfrey. Yeah, so we had a forecast of minus 45. So we, like Annabelle, are not going to make too much or too significant changes to our full year forecast. So for the moment, we're leaving it at about minus 9% for what it's worth in terms of a calendar year contraction. But I think the risks are there that it might actually be worse than 9% contraction. Annabelle talked about power outages. That's certainly something that we initially thought would not be a big deal, just given the deep recession. After all, demand for electricity will come down, and yet here we are. Now we have to factor in power outages, which is certainly going to take its toll on the economy in the second half of the year. As I say, you probably have to think about downside risks to a 9 or 10% contraction for this year. That's a number that's obviously far worse than what the National Treasury and the Reserve Bank themselves expect. So it's not only us that will have to think about the implications, but our authorities certainly will have to do something similar. And this probably would be quite concerning to National Treasury. You're having to plan a budget around an economy that's doing far worse than what you initially anticipated in February. Yeah. You have to sharpen your pencil now.
Absolutely. Talking about the authorities, I imagine I remember after the initial lockdown, the president came out and he said, we're going to talk about getting this economy out of the difficulties that is in. And one of the things that he was going to do was infrastructure spending. Are you guys taking that into account? Or you are saying, hello, Mr. President, until we see the rands and dollars dropping into the economy, we're not adding them to our numbers. Etienne?
Yeah, Godfrey, well, it's not only that. Just remember, there are a couple of factors that are relatively favorable. It's quite clear to me that the global economy is healing. We're starting to see the benefit of that in high dollar commodity prices. Obviously, currency weakness will help. We're certainly starting to see this already in the mining sector. Mining was down dramatically in the second quarter, but it certainly turned the corner in April already. Mining output was up in May, and it was up further in June, for example. Our car exporters, well, they're also starting to benefit from a better a global picture. The agricultural sector is doing just fine, and there's positive spin-over effect into manufacturing. Also think about mining being a good client for manufacturing and construction. So there are a couple of reasons to expect the economy to do better in the second half of this year, and I think that's a good thing. And the infrastructure story is possibly one of them. Perhaps not so much for 2020, but perhaps more so for 2021. But that means, Godfrey, that the government will have to narrow down the projects from the 50 to 5 or 10. They have to make sure that those infrastructure projects have seriously positive multiplier effects to the rest of the economy, and they must start soon. We can't wait much longer to see the dividends of a massive expansion in infrastructure.
Annabelle?
Yes. So look, I think, if we look at the SIDS process, they're looking at about 360 billion in terms of expenditure and 275,000 in terms of jobs. But again, it's not for this year. It's going to be spread over several years. And of course, the reality of the situation is it's not much different to what was in the February budget anyway, from a government expenditure perspective in terms of the, infrastructure. And, if you obviously look at the South African economy, I certainly agree with Etienne that there are some green shoots. The reality of is if you are seeing substantially improved economic growth rates month on month, or economic activity rates rather in various sectors, on a year-on-year basis, they're still down very, very heavily. And that's, certainly for all of the sectors. You asked me earlier, what has been the real contributor to the collapse of the second quarter from a COVID-19 perspective? And, what were the structural issues there before? Obviously, electricity, very much the structural issues there before. Yeah. But I think, certainly if you have a look at the collapses, if we have a look at the industrial production sector, that's your mining, manufacturing, electricity all combined, collapsed by about 73%, in that quarter. And that's, really very much a COVID-19, very hard, very sharp lockdown. The banking sector as well, the financial services sector, all of these obviously have seen very greater contractions than they've ever really seen before. And again, very much from the COVID-19. So I think, certainly, Godfrey, we're in a structural recession, a supply side recession, probably a structurally one as well, because we'd seen a decline in economic growth from, above 3% in 2011 right down to 0.2% last year. And we were anticipating in any case this year would risk being a recessionary year as a whole, just because of that. But of course, COVID-19 has just made it so much worse.
Sure. Very quickly, I wanted to cover two other points. One is we've got the government preparing its budget in the midst of this crisis. So we've got the medium-term budget statement coming up. And I want to know what that means for government finances looking into 2021. And then I also want to know when we'll be back to normal, if ever. Annabelle, I'm starting with you, then we come to Etienne.
Well, look, if you look at nominal terms, the expectation certainly, I think, is around maybe 2023, we might return to the economic activity levels we had at the end of last year, really. But of course, is that normal? And sadly, that has become the normality for us, this declining economic growth trend, this very weak environment. If that's all we aspire to, then, we really are in trouble, because we won't dig ourselves out of the fiscal pit that we're in from a governance finance perspective. And of course, now with a 300 billion drop in revenues coming through from a taxation point, at least, once again, because of this very, very extreme, severe lockdown. Of course, the prohibition on sales of alcohol, tobacco at various points as well. All of those didn't help. The mini budget itself is going to be greatly scrutinized by the credit rating agencies. And of course, we do believe that we may well see a credit rating downgrade in the November period as a consequence of this huge escalation in debt. We're seeing a debt issuance of about 2 billion rand a day, in the working week, and that's highly problematic as well. South Africa, even in the most positive scenario, sees debt peaking around 90%. This is all highly problematic for an economy that's not expected to see very much in terms of a recovery in the second half of this year compared to where it was last year. And of course, last year already had a very, very weak performance. So I think the government's going to have to revise down its GDP growth estimate for this year, certainly, but also, of course, as well, even have a relook at its revenue tax takes. And of course, the reality of the situation, South Africa is highly fiscally constrained and was so before the COVID-19 crisis. So this has just exacerbated the situation, just made it so very much worse.
Absolutely.
And I would add, actually, as well, that a harder lockdown than potentially was necessitated, given that we've had one of the lowest mortality rates in the world because we have such a very young population. And COVID-19 doesn't really affect the young like it affects the elderly, which we have very few. So again, it really seems in retrospect the lockdown was much harsher than it actually could have been.
Thank you for answering that question before I asked it. Etienne?
Yes, Godfrey. I just want to, before I answer the question, also make two additional points. I highlighted a few favorable developments which you should not lose sight of. The other two, of course, is that we have now struck bottom in the second quarter and off an extremely low base. You only need a little bit of positive growth to see your quarter-on-quarter annualized numbers show quite a bit of improvement.
Sure.
And then also, I'm not here to judge, but the lockdown restrictions were very harsh, but they have been relaxed over the last couple of months. And that certainly is creating some return in activity for various sectors. Now, back to your question, National Treasury expects a budget deficit of about 14.5% this year, and then about 9.5% the year thereafter, and about 8% the year thereafter. So if National Treasury were to adjust their GDP forecast closer to ours, for example, a -9 or -10% contraction, my gut feel tells me that the deficit will be about 2 percentage points worse than what Treasury expected in July. So that obviously will then have implications for the debt levels that will also be higher than what they initially anticipated. Absolutely. Your second question is, when will we be back to normal, Godfrey? Maybe just important to keep in mind here is that after the global financial crisis in 2008, 2009, it took the economy about 18 months to be back to levels prior to the global financial crisis. And we all agree that COVID-19 shock is far worse than the global financial crisis. So I think it's just reasonable to expect that this time around the economy will probably take at least 3 to 4 years to see GDP back to levels that we experienced prior to COVID-19. In other words, in 2019. I think that is a very reasonable expectation. Sure. And for that to happen, the government must implement reform. Structural reform and the stuff needs to be forthcoming, Godfrey.
Absolutely difficult times, without doubt. Annabelle, thanks very much. Etienne, thank you for your time. Annabelle Bishop is Chief Economist at Investec. Etienne Leroux, Chief Economist at Rand Merchant Bank.